When to use a mortgage lender and when to use a mortgage broker for your real estate funding. That's the topic for today's episode, and without further ado, let's dive in. Hello everyone, and welcome back to another episode. For those who are tuning in for the first time, this is your channel for real estate education. So the topic for today will be about mortgage brokers. When to use one, what's the difference between mortgage brokers and a mortgage lender, how do I go about it? So I was able to compile a list of 8 key differences between the two and actually help you realize when you should go to one in whatever scenario that you happen to be in your real estate funding. So let's go into the board and learn a little bit about them. So one of the key things that makes up a lender is that the lender works for a bank. They're kind of like a bank employee. They're only available at the branches. They can only sell products that only the bank creates. Now, when it comes to a broker, the broker works for himself or herself. They're completely independent and they're sort of like the middleman. So they're the independent person. Now, because they work for the bank, like I mentioned, the amount of products that they offer is somewhat limited. They can only promote whatever they have available in their bank. This person right here, the broker, has relationships built with multiple banks across the nation, across the town. So they have a variety of products to choose from. This, whatever, right? They have more options. With the lender, you're gonna have to build a relationship with this one person. And just so you know, lender could be the bank or a lender can be the mortgage officer that you're working with. So you can actually come in and introduce yourself, establish that relationship. This will be your go-to person, or this will be your go-to bank, and you have a long life of relationships, someone that you can actually just call and send a quick email right away, and you can work on having that loan approved for you. So the relationship. Now, here, the relationship is a little bit different. Rather than building your relationship with multiple lenders, in this case, you rather save the time. You don't have time to go to 10, 20 different banks just to say, hey, this is me and I'm a real estate investor and I want to build it. If you could do it, if you have the bandwidth, great. But sometimes if you're busy looking for real estate deals, believe me, you're not going to have sufficient time to go out and talk to 20 different lenders at the same time. So that's when you're going to come in and you're going to leverage your brokers. The broker will go out and he's going to branch himself out and he's going to send, I don't know, a blast email to all of his contacts and say, hey, I have this deal. What are your rates? This is what they can do for you, what they can do for you, and that, right? So you have 4 lenders to choose from versus having to choose from one lender on your own. And this person may or may not offer something that could work, or they may, who knows, right? So to my next point, because they're only limited in the number of fundings that they can offer, they have only certain products that they can offer the customers, as opposed to the broker. They have, let's say, type A, B, and C. If you have a very strong relationship built with them over the years, they could make some exceptions with their products. So let's say, for example, they say, well, we'll require you to have a FICO score of 750 in order to qualify for this product, right? But let's say your FICO is only 700 in this case. Depending on their quota, depending on that relationship, depending on how much money they have available, they could bend the rules and say, well, we might be able to qualify you for a FICO score of 700, but you're gonna have to deposit $20,000 into our account and not move it over the next 12 months. So yes, they're giving you an option. They are sort of like bending their own rules to accommodate to you, and it's up to you to decide whether you wanna go by it or not. However, if you're too busy to even negotiate, or maybe you did not like their terms, you decide to go to a mortgage broker, the broker is going to come in and say, well, I have all these 4 other lenders, and then lender A is willing to lend you at 620, lender B is only willing to lend you at 705 for your credit, and then lender C can offer you, I don't know, let's say a loan at 750, and lender D can only offer you if you have a credit score of like 600. Mind you, for each one of these, even though they're requiring different FICO score, their interest rates might be different. Maybe for these two, even though they're willing to lend you with a lower FICO score, maybe they have the higher interest here. Maybe this person is asking for 8%, and maybe this bank is asking for a 10%. But then these ones over here, they're doing 6%. And this one is doing, let's say, 7%. So it's up to you to decide which one do you want to leverage. Do you want to just worry about what you can resolve today, which is this, because you don't want to pay the $20,000 here and deposit it into this bank account and having to wait another year before you can even use it? Or you can just simply apply the approach of closing with each of one of these loans, or you can just simply choose to take care of what you can today and say, well, you know what, I can only qualify for each of these three. I'm going to go with this one and just get it out of the way. Maybe 12 months down the road, you were able to fix your credit and now you can afford a much better loan with better terms because you now have a higher credit, and then you can eventually come back to this original lender that you reach out to and say, hey, can you refinance this at a lower rate? Now I have a 750 FICO score, and they might be able to work something out for you. Now, the next difference that you have is when you go to a lender, you have to do all the paperwork. With a broker, they do all the paperwork for you. And again, back to the topic of availabilities and options, when you go to a single lender, let's say, for example, you can only get a certain rate, whatever is it that they're getting. Now, if you go to a broker, by default, you're more likely to get lower rates. Why? Because brokers do not get paid unless they close on a loan. Mortgage lenders get paid a salary, and in addition to that, they receive commission. So whether they close or not on a loan, they still get paid. Here, these people gotta pay their bills. If they don't get you the best rate, guess what's gonna happen? You're gonna go to their competition and see if they have better rates than this one broker. So by default, they have to offer you the best rates possible in the market. And by default, because the lender works for a bank, they have to abide by their working hours. So they're usually in an office from 9 to 5 working for them. A broker can basically work from the comfort of their home. They don't have to abide by 9 to 5. So you have higher chances of being able to find them. And you want to send somebody an email, let's say at 9 p.m., there's a higher likelihood that the broker will get back to you as opposed to the lender, who you will have to wait until the next day to go check their email at 9 a.m. in the morning and get back to you on that one. And that's it. This was meant to be a simple episode. Hopefully you found that useful, and hopefully this will help you make a decision as to who you should reach out to when it comes to funding. And as usual, don't forget to hit like or the subscribe button. And if you know of somebody who will find this information valuable, feel free to share the love and send the video their way. And until then, I'll see you guys next time. Take care. Bye-bye.